My topic that initially what I had proposed was read everything, believe nothing. And I just made it up. And then when I was trying to write it down and say what I would say, it didn't make that much flow and sense. So I've changed it a little bit to read everything, question everything. You know, I read a lot, and I believe that reading is one of the best ways to be a fund manager and to make money. And you know that all the big guys of the world read a lot. I have not copied from them, but I'm happy that we all do the same thing in some sense of reading, so you should all read. And you know, people ask me on Twitter and otherwise, I've read this book, or which is your favorite book, and give me one book which will, you know, make me better fund manager or better investor or whatever. So my thing on that, just a few lines on that, is that there are two sides to everything, and you can read unlimited amounts and still be a learner. So if you look at this book called The Little Book of Value Investing, this is not being recommended actually. I'm just saying that you could have also read the little book which recommends growth investing. And if you read only one, you feel that you've read this book and therefore you are you have learned what is there, but the same things will come every day. So there is this book from Benjamin Graham on value investing, and everybody thinks he's a great value investor. But you will also have Benjamin Graham on growth investing, which you may not have heard of. The point is there is no end to this, and that is why when I'll come to my philosophy and all, the point is that all these help you read, but you still have to question, because there will be another side to every story. So if you look at this book, it says madness of crowds, and you may think that therefore, you know, that you've learned that and taken away that, whereas then you'll realize that Google has been formed and is the most successful company in the world, or second biggest right now, because of the wisdom of crowds. Bottom line being, there is no end to having the other side of the same argument. And my philosophy is that in our market, or actually maybe in financial markets in general, nothing is what you see. So what this means is what you see is not what you get, unlike what happens with many software programs. Basically, there's two levels of gamemanship that is being played. One is corporate sector telling the fund manager something which is not the true underlying truth. And the second is fund manager telling you a story which makes him appear in good light. Oh, we are long term, you know, we buy quality, we engage with this and all that. So my story today is to tell you about the dark side of my business, which is the fund management business, so that you can question correctly. Because right now I feel that the biggest risk in India is the fund managers and the crowd giving money to these fund managers, more than the companies or the government or economy. So my philosophy in short is de omnibus dubitandum. What does that mean? That means everything must be doubted. So let me explain it in Hindi. That the song says, अगर दिन को अगर रात कहो तो रात कहेंगे, तुम दिन को अगर रात कहो तो रात कहेंगे. The philosophy should be, अगर तुम दिन को दिन कहोगे तो हम चेक करेंगे कहीं रात तो नहीं है. So everything must be doubted, and I will tell you on the simplest of these motherhood statements that are made in our business, that how you can have another side to it. It does not mean that the first side is wrong, but my job here is to not to enlighten you, but to confuse you so that you yourself get enlightened that there is a second side to everything. Anyway, I made it up last Saturday, Sunday, not to worry. Okay, so why I get bugged with these high priests of finance who say we buy long term, we buy quality, even we buy long term and quality, but I have to read this out because it is too good. So it's not the philosophy of theirs that gets me, it's their pomposity, that they are pompous. If they just laugh at themselves, if they just say that this is what they think, that this is what their guess is, but there might be another version of it too. If only they'd explain that this is their best guess. So I will tell you my best guess now. So my theme now is to talk about 10 or 15 assertions that people make and how we can find another side to it. So let's apply de omnibus dubitandum or doubting to these assertions, which if you're a trader you may not even have heard. I hope you've heard, but if you're an investor, all of these are very, very common assertions that are made in this industry of ours. So first is, we buy stocks where we have high conviction. Now this looks like a very logical thing, but since we question everything, we question even this. By the way, at the end of all of these, it's not that we are just trying to find holes in either a funny way or just for the sake of argument. All of these we employ in our thing, which I will summarize at the end. So it's not just for the heck of trying to prove something wrong. But according to us, people don't buy their high conviction ideas, they buy their lowest conviction ideas. Actually, the highest conviction ideas are rejected. Let me explain. So if Warren Buffett says that I don't like tech, and therefore he refuses to do further work on it and then goes on to study other things, it means his highest conviction is that he does not like tech. For example, I say again and again, I don't like state-owned companies. That does not mean that I say, I don't like state-owned companies, but let me meet the management, let me go to their plant, let me see their annual report, and then I say I don't like it. I just say I don't like state-owned companies. So in theory, my highest conviction is in what I don't do. Because what I do, I keep probing more and more to see whether it is right or wrong. So if somebody comes to you and says that we have a 50-point checklist before we buy a stock, and let us say that he has by that time checked 48 of these items, that means he's still not convinced. So it can't be a high conviction idea just because you did more work. If you do less work, that means you have high conviction, whether right or wrong. And that is true of everything in life. So if you want to get married and you meet a girl and you say not interested, you don't explore further how is her family, how is her, where does she work, or how will it work out. You say not interested. So the whole idea that we buy high conviction by its design is wrong. And how we do it I will come to later. But basically what we say is that your highest conviction is in rejecting. Therefore you reject. And whatever you can't reject, you buy. And I'll explain further what it means in a practical sense. But the first line itself, according to me, of the fund management industry, that we buy high conviction is wrong. The second one, of course, many of these will say that our favorite holding period is forever. Can anybody tell me who has said this line? Actually, nobody has said it. This is the line. The line is, when we own portions of outstanding businesses with outstanding management, our favorite holding period, he does not even then say that he will hold it forever. He still keeps it as an option. So this whole, and by the way, if you type on Google, the first line will come as a quote. It won't come that it is part of a quote. So people have summarized it just because it sounds good. According to me, it is philosophically wrong to hold a stock forever or to say that you will hold it forever. By the way, Warren Buffett is one of the most brilliant guys in the world because what he says is very different from what he does. What he does is what he should do. And what he says is for you to not do those things that he does. And therefore people who read his and tweet to me and fight with me on Warren Buffett, actually he himself doesn't do it. I can give you as many examples as you want. So he was against Donald Trump, he was in favor of Hillary Clinton, and in the first week after election he himself said that he bought $12 billion of stock. He obviously buys derivatives, he has bought against the index and all, that index, he sold a put. Then he said he does not like all the airlines, then he bought airlines, then he says he does not like cyclical, he bought Exxon, then so on and so forth, there will be one or two more, but basically the point is, and he does not hold stocks forever. But again here, he only said, when we own stocks which are good, if you own stocks that are good, that continue to perform well, why would you not hold them? But that is not the starting point of the thing. So then somebody will come to you and say, we own stocks for the long term. Now this we also do, but I still want to find another side of everything because that's the only way you become sort of a little higher than average in terms of thinking of this business and the way to do investment management. First is, if you go back to the previous one, the why we hold stocks forever. No, how do we? Oh, it's gone back too much. Is basically, if you say forever, actually the philosophical wrong thing is that your biggest advantage in being in the market is that you don't have to hold things forever. You can walk away, unlike a promoter. So there is no reason for you to even think upfront that you have to be his partner forever, because that is the biggest thing you have got relative to a promoter, that you can walk away. And we know that the failure rate of companies, the way companies nowadays get disrupted, is that you should not even think like that. You should not even have the arrogance to feel that I have seen this clarity forever, that this is the best stock. You can see 2, 3, 5 years, and that is a fair horizon to have. So we own stocks for the long term. Now read this again from Warren Buffett. And this is what I think. I mean, this one I agree totally in the sense that how he's written it, which is that let us say you hold stocks, you should ask your fund manager, that if you hold stocks for the long term and you hold 20 stocks, so you looked at say 1200 stocks or 1500 stocks in India, in theory you analyzed them, you looked at their fundamentals, you looked at the prices, and you found 20 good stocks. Now let's say 1 year has passed and all these 1200 stocks, their prices have gone up or down, the fundamentals have moved up or down. What is the probability that you will find the same 20 stocks when you do this study next year? It is not theoretically, conceptually, philosophically possible that you'll have the 20 stocks. And this is what he used to say in the past, Warren Buffett, if you read it. But now over time, as he became bigger, he says, okay, keep you guys happy, okay, I hold it for a long term. But actually this is his original quote when he was not of the size, he was always bigger than anybody in this room, but basically younger in his thinking, that it is not possible. So that also is a wrong thing to commit to, that I will hold it for long term, as if it is an ego point, as if it is your God's gift to mankind that you held the stock for long. The bottom line is, you analyzed it every quarter, and if you held it, it basically means you decided to push it forward. So for example, I have held HDFC Bank for 20 years. I can't say I've held it for 20 years. Every year, or let's say every 6 months, we looked at it, it looked good. So we kept it. So it's a series of short terms. We could have at any time walked out. We didn't say to anybody that we will never look at it again because we have bought it. In fact, this idea that our fund managers say that put all your eggs in one basket and watch that basket closely, that means it is not long term. Long term means you should not look at it. But nobody says that. They say own it and then analyze it every day like looking at those eggs in a basket. So if you do decide to keep it for another 1 year or 2 years, it does not make you long term according to me. It's just that you have pushed forward for 1 more year saying good so far. The other one is again on this ego battle with some of our PMS guys in India and others. Oh, we own 10 stocks. Oh, we went to Warren Buffett conference in wherever, Omaha. But the point is, Warren Buffett never does like that. So this is a paper, academic paper, written by these 3 professors, John Hughes, whatever, Ying Liu and Ming Chen Jiang. And they have analyzed for 26 years the companies that have been bought by Mr. Buffett. And this is based on the filing that they have to make every quarter as to what they own. So for 26 years of stocks that were disclosed that Berkshire Hathaway had bought and sold. And secondly, another large number of stocks where the company had taken exemption. So those were reported later, but still later on in 26 they found them. If you see, Mr. Buffett's holding period is only 1 year. And 20% of stocks only are held for more than 2 years, and 30% stocks are sold within 6 months. So I hope Mr. Anuj, who's sitting somewhere in this room, knows the question to ask next time he sees a guest bullshitting him about Warren Buffett. So then the next one people will come and say is, we buy companies with good managements. First of all, what does that mean? So what does it mean to tell you as a retail investor that you buy companies with good managements? Does it basically mean that you buy companies where Business Today wrote an article on the company or where Business India wrote an article on the company? Well, how will you know that it is good management unless the stock has already done well? Once in a while, you will say that my neighbor or my classmate or my relative has started a company and I know he's a good guy and all that. So true, it's possible. But in a big picture sense, how are you supposed to know till the stock has already done well that the management is good? Because how will you separate the halo effect? The halo effect basically means that if a company is doing well, you will say that the management is good. And if the company is doing badly, you will say the management is bad. You cannot separate these. Once in a while you can, like we think in some there are very good corporate governance, things like, according to me in the past, iShares and Max and all did, which were separate from the company and performance. So that you can do once in a while. But at a philosophical level, you cannot know what is a good company or what is a good management separate from each other. But let me give you specific examples of this. What is the halo effect? By the way, this book I recommend is one of the best books. Maybe it's the #1 best book in business called The Halo Effect. So in May 2000, the price of Cisco was $80 and the market cap was $500 billion. And it got rated by Fortune as the most admired, or I think second most admired company in US. And this is what Fortune magazine wrote on Cisco in that issue. That Cisco must be one of the America's truly outstanding companies. No networker has done better customer service. John Chambers is the most customer-focused human being, blah, blah, blah. And then everybody in the company flies coach. And then 1 year, the stock price fell to $15. And the same Fortune magazine says, Cisco has exhibited a cavalier attitude towards potential customers. Cisco's sales techniques have been irksome and have alienated customers. And acquisitions, forecasting, everything has been bad in the previous year. In that book, there are many examples on ABB, on other companies, on the toy company, many companies, examples which are given, where actually the period is too short to have everything fall apart except the stock price. And when the stock price falls, the whole story changes. So in India, whenever somebody says that the management is good, we have bought, it's not that. It's a mixture of many things that are happening. You can make yourself happy that the management is good. But if for whatever reason that management has a problem or the company has a problem or the environment has a problem, the same management is called bad. But another example in this book which I like very much is that these guys have quoted these big studies. So one was this book which I had read in 80s called In Search of Excellence. And it was a big hit in those days, written by McKinsey consultants. And then this guy, the author of Halo Effect, studied the performance of these companies over the next 10 years after the study came out. And he found that 13 had outperformed the index and 18 had underperformed. This is when somebody did a full book study on finding the best companies in US, and then for at least the next 10 years, they actually underperformed. So just saying it was a good company, here we say, because I read in Business Today or I saw him on CNBC and he was answering 3 questions which may have been pre-told by Anuj to him, I don't know, that, he answered them well. But then there was this other study called Built to Last by these 2 guys, Jim Collins and Jerry Porras. So they identified 16 companies. They also did some massive research. Big book was written. And again, for the following 10 years, 10 of those 16 underperformed the index. Then the same Mr. Jim Collins, who I call the same Mr. Jim Collins, wrote another book called Good to Great. So he did one study in 90 and one in 2000, and he found another, 11, 12 companies. And what is the surprising thing? Not one company is the same. So after doing some 3-4 years of academic study and defining how he considers good management, he found the companies that he found in 1991 or 1990. Not one company was there in his next study, which he did 10 years later. And now if you can look at the names also of these 20 companies, half of them don't exist in the form in which they were that time maybe proposed. Citi, Ford, HP, IBM, Motorola gone, Sony gone, Fannie Mae bankrupt, Walgreens in bad shape, Circuit City, I think, bankrupt. So, please, enough. Then the next one we come up with is, because this is one of the things I believe in, diversification. They say that diversification is a protection against ignorance. It makes very little sense for those who know what they are doing. Basically, it means diversification is a protection against ignorance if you know what you are doing. So if you put a word if, you can put anything. You can say anything and say, but if you got 10 successive 20 baggers in a row, you will be like this and that. So if has no meaning, but this is with an if in it. And first is we don't know, we are ignorant till something happens. I have had the pleasure of owning stocks that have gone to zero, including Amitabh Bachchan Corporation Limited. I'm deliberately giving only that name because it's unlisted. But ABCL we invested and it went to zero, we marked it to zero. And I guess after that I left Alliance 3-4 years later, but I don't think anybody gave anything back to them. But I got invited for his birthday in that year only, not now. So the other thing people say is that concentrated funds do better. So now let's do a thought experiment. So in this room, let us say there are 20 only concentrated investors out of 300 people, only 20. And they all think that they will only buy 10 companies each because they believe in concentration. Now, unless you say that half of them are common, let's say 10-20% are common, so actually they bought 7 companies each. So there are 140 companies that the concentrated guys think are good, in which they are willing to concentrate. So if I buy 40 of them, am I concentrated or not concentrated? The point is, there is no such thing. It is right or wrong. If you are right, you can be as concentrated as you want. But broadly speaking, even if a fund manager, if I buy 2 concentrated funds, suppose I am a pension fund, or I mean a bigger investor, instead of being a fund manager, so I buy 3 funds which are all concentrated. So now I'm not concentrated or I'm concentrated? This nonsensical argument of people just because they want to sell a story to you, because they want to sell you conviction with concentration. Nothing like that in this world. Because you could be ignorant and concentrated. First of all, if you know this much, that you're ignorant or not, that itself is a big achievement, but that is what people don't know. So you could think that I'm not ignorant, and you could be ignorant. Okay, now this one is, this guy came to our country last month, Howard Marks. He's a big guy. So I wanted to, because I read everybody to see what I can find to learn. So here he says, before investing in an idea, my son has been trained, obviously by him, to ask, and who doesn't know that? So anybody in this room who owns any of these private sector banks, I just met a guy who said he owns Yes Bank, please stand up and tell what you know which others don't know. Nonsense. How will you buy Berkshire Hathaway? What is it that you know about the other? I think that Warren Buffett will be alive for another 10 years. Nothing you know. It's an analysis of the same information. There is nothing, unless he was hinting that his son should get inside information, there is broadly nothing that the other guy doesn't know. We have people here who say, I went to my neighborhood and I met 3 underwear dealers and asked them, do they buy Page? That is not research. The point is everybody knows everything. And anyway, then they tweet about it, so other guy also knows. So point is, there is no such thing as to who doesn't know it. Everybody knows it. Everybody knows more or less everything, and that is where the money is made. Otherwise, the standard of, I own a lot of I own a lot of Google. You think I know how it works? I don't know anything more. I own Walt Disney. What is there to know that I know more than the guy sitting in US, but the stock has gone up in 5-6 years, gone up some 3 times. But what is there to know, and why should you have that as a standard? He's basically making his son go for insider trading, is what I think. Okay, so then the other one is from this Twitter side, Micro Cap Club or whatever they call themselves, saying, to make money in a company, you must know it better than anyone else. Okay, fine. What is the flaw in this argument? Tell sir, what is the flaw in this argument? That to make money in a company, you must know it better than anyone else. No, that could be one answer. But my answer was that that means in every company only one guy can make money. Because only one guy can know more than others. Because it's like a relative grading. If you know something, if I know more than you, I'll make. If I know equal, we'll make half-half. So the point is, every company, one person can make money. But it looks such a good motherhood statement. We know the company like the back of our hand kind of thing. And you know that the CEO of Volkswagen didn't know that his numbers were being rigged or his tests were being rigged. And so many other companies like that. By the way, my classmate from IIN, who I just met recently also at a get-together, he was the head of strategy at Satyam. Seriously, from IIN Calcutta. Okay, this is for today's times. We have to just buy growth. This opportunity is very big. This company will execute for 10 years and therefore doesn't matter. So this is from a book, it was a good book, but first the question. So these guys have compared for 53 years the earnings per share, let's say, you can take revenue per share, dividend per share, for IBM and Standard Oil. I don't know in the back, can you see or not? But basically, IBM grew its EPS at 10.9% per annum for 53 years, whereas Standard Oil grew it at 7.5% per annum. So if you want to compare the two, this was like 50% more than that or 3% more than that. So tell me, after 53 years of such great performance, by how much did IBM outperform Standard Oil? Came down? No, how much did it outperform Standard Oil? It did not. It did not. After 3 years of growing at effectively, because the base for the other guy is only 7. So 7 versus 10. I mean, you know, if it was 30 versus 33, it would have been a different answer. But 7 versus 10, for 53 years of growth, it didn't catch up. There is no such thing that, oh, because growth is there, I don't care for the PE. That is not an answer. You can broadly say that, okay, I will be a little bit more liberal here, but you can't say that I will not look at it because this company grows. Because that, again, everybody has discounted in some form or the other. Then I got a bit more excited by my argument, so I made one more. That is just for you guys. So this says, good people say, or some of these guys would say, we don't buy businesses which are otherwise bad for humankind, humanity. Which I don't know whether they are bad, like liquor and all, they're okay. But, you know, that which are bad for humanity, casinos, gambling, etc., etc. So I came up with the argument that only good people should buy these businesses. Why? So let us imagine that these businesses are otherwise good, as in they make money. You're not rejecting it because it's a bad business. Correct? Because otherwise you can say, I don't like the business. You are saying that it's a good business, but I don't buy it because I am a good person and I don't like these businesses from the angle that they cause harm to humanity. So if you don't buy these businesses as being good people, then bad people will buy these businesses and bad people will become stronger. Because the business itself is good. So the correct thing is for the good person to buy these businesses, to hijack the profits from the bad guy and use that and do charity in protecting cows in India or whatever else you want to do. Okay, now the next one is my current irritant, which is ETFs. Because these ETFs are bugging all the active fund managers because people have been brainwashed into thinking that the fund management is a zero-sum game, which it is. As in, all the guys cannot outperform the index. So, and because there's a cost also of management fee and all, so the active group as a whole does not outperform. So some 30%, instead of 50-50, say 30 will outperform and 70 will underperform because some of it is cost. Therefore they say, buy an ETF, save on costs and accept average returns. So let us use this philosophy in real life because there's no difference. This is the same as real life. So your son comes to you and says, I want to go to IIT. So you should tell him that only 5% of people who try for this get admission, and others will spend their time and money in going to quota and learning this course, and anyway in the end only 5% will do well. So you don't sit for this exam, you accept the average of your class, which for India is $2,000 a year per capita income, and there's no need for you to try. You could do this in anything and say that the odds of succeeding are less, because that is how life is, and therefore we should not even try. But the second one, and this somebody may not say philosophical, is that this will also only last for some time, because as you can see today, it is leading people to put more and more money in an index which itself does not care for quality, it does not care for what the company is doing. As long as in the index it is bought, and that reduces the research that is going on in the country or in the market, and therefore in the end it will not work. But in the short term, if you look at, you can type on Google, I didn't want to make another slide, but you can just type the guy who founded index funds, Jack Bogle of Vanguard, himself has written against ETFs on the basis that the ETF guys make 1.7% per annum less return than the index. Why? Because the guy who buys the ETF, not the guy who buys an index fund, but the guy who buys an ETF, which is trading on the exchange, thinks that he's a trader. And so what people were doing with stocks, he does with the index. And this is his own study. You can see it in Financial Times in December 16th of 2016, December 2016 date, I don't know. But I just searched and you can find it there, saying himself that in the end you cannot escape it, unless you buy it and forget it. But the guys who buys an ETF comes in with a different attitude, because again the product has been misused. The product is used to time the market. And so he has, with his own data, and he's saying, please don't do this, that was not the intention of the index fund. So some of them will be outperforming if they don't do that trade. But at an aggregate level, even ETF, you cannot outperform us or people like us if you trade it. This one is in honor of TCS and some other companies, that some of these guys buy 2% buyback at some 20-30% higher price and make it look like an investor-friendly move. It is actually the most investor-unfriendly move, and I would think that SEBI should ban it. Because what happens is, and they can see actual data, I've seen it for a few buyback offers, that the small guy does not tender. Because for the small person who has 100, 200 shares, he thinks that 2% is not worth the effort, because he will get a few hundred rupees more on his tendering of the offer, and the large guy tenders. So individually you may say one guy is not tendered, but that becomes 8-10% of the shareholders who don't tender, because individually they are holding very small amounts, and therefore they don't feel it is worth tendering. Also people who may be holding physical shares still and all that, but that is less now. But the point is that the large guy basically gets a higher proportion of his offer accepted. This is again one of my favorites, and after this there's one more, which is the main one, which of our current fund, is that without any research, people say that there is, people means government, says that there is a lot of round-tripping money in the Indian stock market, and these FIIs or P notes or all these guys are fronts for Indian guys. So let's look at it. Which money leaves India? So it could be bribe money, corruption money, real estate money, or defense money and stuff like that, and some corporate money also. So please tell me that with this great difficulty, these guys get either paid abroad or they get paid in India and they do hawala and they take it to Mauritius, and the first thing they remember is the Indian stock market, that they must put it back. And knowing that once they put it back, they will always be scrutinized, because now you are coming back into India, so even after 10 years if you are caught, this will be frozen. Second is, till few months ago, even Indian public was not investing in the market. So why would it be that a guy leaving India suddenly discovered that he must come back? And my third one was, which I've been arguing on CNBC and others, but That give me one example of somebody who did round tripping and you caught. One. At least tell two names, one name, and then you say, no, this is only a sample. They have never got one guy and they keep shouting from their rooftop that there is round tripping money, round tripping money. There will be some money of that, some corporate who may have come back and bought his own stock. But that will not be 1%, 2% of the money that is coming into India. But this whole thing, oh, this money came back to India from some Indian sounding NRI, these kind of arguments make no sense to me. But now coming to my final one, which is a slightly bigger, because we run a long short fund and we are always bullish, or I am always bullish. So then people come and say that if you are bullish, why should I buy your fund? Because you short also all the time. And so you are a long short fund and your exposure to the market is only on average 60%, but you and you want us to buy this fund relative to a long only fund. So I had to find an argument against this, and not argument but data. So I'll ask you a question, which this I used last time also in the conference. So if you know that a market will go up 100% in 2 months, guaranteed, would you prefer to buy a long only fund or a long short fund with 60% net exposure? Which means, I'm not saying that I will outperform, that my shorts will not fall or will not, or my longs will go up more. No, no, no. I will get 60% of the return of the market. So which fund will you buy? That is because you know that I am defending it. But otherwise, 100% long. So let's say, answer is it depends. So let us say that in the first month, the market goes from 1 to 10 or 100 to 1000 and then falls from 1000 to 200. So the market has doubled in 2 months and that was the, and so you as a long only guy will get 20%, 100% return, 200%, your NAV will become 200, correct? Now for a 60% guy, when the market is going up from 1 to 10, that means the market is up 900%. A long short guy or a guy who has only 60% net will go up 540%, 900 into 60, because 40 is not invested or he's losing on the short side against 100. So his NAV becomes 640. But when the market falls 80%, as it did in the example, from 1000 to 200, here the long short guy will fall 48%. And so the NAV will be 332. So in this scenario, the long short guy will do better because there is monthly rebalancing. That means when it went at the end of the month, you went again to 60. You can't not change anything, then you'll also get 200 or 120 in this case. But the point is, this only works if the NAV, if the market goes like this. If the market is, like suppose it went to 250 and then went to 200, it won't work. It will only work if it is very volatile, if it is very steep. So the question is it real? Because this example looks, created on paper to show that 60% net will work better. So the idea is, what is the reality of India? I want to show you, and then I will show you the actual fund data of all the funds here. Not all, but a few of the funds. So actually, first the magic, even in a scenario where the market is up to 100%, long short funds can do better. But first let me say, India, what happens? So, but to do that, you have to compare it to US. By the way, if you want to take away anything from this presentation, these are the 2-3 slides. You can ask questions because this is my original deep stuff. So the US market in 12 years, slightly less than 12 years, this data is from the time when our fund started, which was July 2005. The market has gone up 91% in dollar terms. If I take all the positive months out of these 140 months, of which there are 87 positive months and 53 negative months, in the 87 positive months, the market went up 11 times. That means 1 became 12. And in the negative months, it fell 84.5%. So the 12 into 0.16 is what was left, and your return became 91, or the NAV became 191 because you started with 100. You can do like this because returns of a fund or of a market are basically multiplication of different month returns. So A into B into C into D is equal to D into B into C into A into A into D into B into C. You can mix it in any form. So I have just put all the positive months in one bucket and all the negative months in the other to show you what happens in those 2 months. So here what happens, if you stayed throughout, you got 91% return, but it didn't happen that you first went up 11 times, but in a mathematical sense, you went up 11 times and you lost 84%. But now look at the Indian market, and then I'll show in fun. So the Indian market during this period went up 135%, which I don't know whether you can see or not. But in the positive months, it went up 140 times. And in the negative months, it fell 98.3%, which means you can do what you want in the positive months. You were left with 2% after all the negative months were over. It's just that these negative months didn't happen together. But that, as I said, doesn't matter mathematically or actually. Point is, whatever you did in the positive months, you were left with less than 2% after the negative months were over. So if in all the negative months together, instead of falling 98%, you fell 96%. That's it. Your returns would be double of the market. And this I will show you now with actual data of all these funds. Now this, I don't know, you can't see at the back, but basically HSBC fund in the positive months went up 182 times, while the market went up only 140 times. But in the negative months, the market fell 98.3, he fell 98.8, which doesn't look any different, and he underperformed the market. Whereas Aberdeen Global, in the positive months, went up only half. He went up only 72 times in the positive months. In the negative months, he fell 95.5. That means he had a 4.5 left. Instead of the index having 1.7 left, he became number 1. And we did better than him because we go up less and we fall less. So in India, because of the amount that it falls, if you can fall a little less, it is disproportionate. Because, say, instead of going up 140 times, you went up only 40 times in the positive months. Now that looks pretty bad, that the market has gone up 140 and you've gone up only 40. But in the negative months, instead of market falling 98.3, you fall 90. That looks very bad, that what great protection did you do that the market, whatever it fell, you also fell 90. But now my index is, I am 400 into 0.1. So I am 4. Whereas this is 231, so I beat. So the game in India is to lose less on the downside because the downside is so high. That even a small saving, because the residual is so small, residual is only 1.7 in the history, I mean, up to March, that you could have saved 1, and or 1.7, it will be double of the market. And your returns will be double. Nobody can argue, your returns are double of the market. It's not, it looks double, it will be double. You would have outperformed the market by 100% by falling only 1.7% less in the negative months. So now let's come to ours. So basically we say that rejection has higher conviction than acceptance. That means you reject. You don't buy. You don't buy the positive, you reject the negative. So what that means is, people will say, you know, I did 50-point checklist and I studied this and that, and then a new fund manager will come and say that, okay, 50, okay, I did 52. So I am checking 52 things. So the first guy will say, I will check the suppliers of the company. Then a new guy will come and say, I will check the suppliers of the company. There's no end. But on negative, one item and out. This is what I was telling outside, one item and out, like murder is out. So there are so many things where you can just say that we will not accept, doesn't matter anything else. And the research is on eliminating bad, not on differentiating between good and good in an attempt to buy conviction, in an attempt to be convinced. I will deliberately do research between two companies let us say HDFC Bank and some other bank, Kotak Bank. You want to do over analysis, you do, but doesn't matter. Broadly, you're playing the same kind of concept. And so this over analysis between good and good we will not do. It is only between good and bad. And we will not be concentrated. Because as I said, there are enough companies that the concentrated guys are buying and thinking that they have done well, and you could buy a sample from them if nothing else and still do better. But if you look at the number of stocks that go up 20% in a year, there are hundreds of stocks in India every year. But if you look at the performance of the funds, one or two funds only have done more than 20% per annum in rupee terms in the last 12 years. So there's enough choice. There's no need to say that if I diversify, I have made my portfolio worsen, because you don't know. But even otherwise, there are enough stocks that are going up that you may have improved it by mistake. Just because you think a stock is good, the stock doesn't know A, that you own it, and B, that you think it is good. So it has no responsibility towards you. The third one is what I was saying in the beginning. I don't think that there is much value for information, because even if you think that people have inside information, mostly the same person does not have inside information on every stock. So even if you're buying 20 stocks and you think that fund manager he may have had on one stock, big deal. It is not going to change his life. Mostly the information has no value. Look at it differently. Before a result, there is speculation whether somebody likes it or it thinks that the result will be good or the result will be bad, and therefore there is a lot of in trading volume, because somebody who thinks it is bad is selling and somebody who thinks it is good is buying. Please ask why there is even bigger volume after a result. Now everybody has that information. Trading does not stop, because once in a while it stops, it goes limit up kind of thing. But broadly, the stock still trades and actually trades more. There is no this thing after the result that now everybody's got the result. So now either they will sit and analyze it. Nobody analyzes it. They will have some flash news and start banging it away. But the point is, that means the information did not cause that volume, because even after everything was known, they're still trading it. So we feel this day to day in that sense, or second to second of the long side, at least for us, to analyze that whether the result is 20% or 20.2% makes no difference. It's a waste of time, and you guys do whatever trading you want, but don't trade on this irrelevant stuff. The other one is that the highest weightage that we have in a stock does not mean that we think it will make the highest return. So in our portfolio, we put it in two ways. One is high confidence in reasonable return, and one is reasonable confidence in high return. So high confidence in reasonable return is all these private sector banks, where you think that you will make enough, you will outperform, but you will not blow out the lights, because that has already been done. But that compounding will be so high that over time it will be still very good. But even if not, if the market turned bad, it won't embarrass you, it won't fall apart, it may fall less, and that has a big value. So the highest return does not have to come from the number one stock that we own. And that is why I don't believe in this concentrated, where somebody thinks that, in an attempt to become wealthier or richer quickly, that I must put 30% or 40% in a stock. Because again, one guy will be right and one guy will be wrong, and the guy who's right, his story you will hear, and the guy who's wrong, he will disappear from our market. The other one is this, which is more I made in a thing on how we trade, which I'll show you some examples. But the bottom line is, a difference is a difference only if it makes a difference. Which means if MTNL is selling, let us say it's head office, it makes no difference. But the stock will go up and then go down. Then somebody who's very indebted will say, I'm selling one plant, or I'm selling one land. Who cares? It makes no difference. Just like it makes no difference to the world whether HDFC Bank grows at 20.5 or 21. 15 and 25 will make a difference. But the decimal places will not make a difference. But still, so much effort and time is spent in trading. In the end, there is no way that you can outperform a guy who doesn't even do that analysis. And my other one is in terms of the things that I found recent and some old one, on you can easily without asking anybody know that these things are wrong, as by connecting things. I'll show you some examples and only I can explain this. So, we were short in Satyam before the Satyam scam. It was 3% of our fund. And even we were asked by the regulator why we were short. The point is, if you look at it, so on December some 16th or 17th of 2008, they had done this deal with Weightage which failed. So that time we were not short. So after that, they said now we're going to have another board meeting in January, on January 8th or 9th, and we have hired DSP to tell us what to do. And suddenly the rumor became that IBM will buy. Now first of all, think about the corporate world. In 3 days ago, you are trying to you are trying to merge that company with Weightage, and 2 days later you are saying IBM will buy. And on December 29th, 3 independent directors of the company resigned on the same day. That is the day we shorted. And so the logic, you tell me, so the deal has just cancelled or been thrown out by the shareholders on December 16. And on December 29, 3 independent directors resigned because they can't allow us, or they will not like to see in their period a sale to IBM in case it helps shareholders. What sense does it make? So IBM actually wrote to them saying that you should question every guy who did not short or sell his stock as to what was he doing. It is such an easy connection that something has gone so wrong. Their 3 independent directors have suddenly resigned on the same day. But no, and then on the last day, we also never believed that it was this kind of a scam. We thought that maybe Satyam has given some intercorporate loan to Weightage, and so they will find that some 100 million, 200 million is missing or more is missing because that company was in distress, this company had $1 billion, so it must have given some money. Of course, that was our luck that he had no money. But the point is that it was so easy to connect. Now look at recent ones. So very recently, Kotak said that we are doing a press conference, and by the way, we own a lot of Kotak, and next day was the AGM. Now who thought this idea that in that conference, they will announce that we will buy Axis Bank? First of all, please note, Axis Bank is publicly listed. Axis Bank has a 10 or 15% shareholder government. Next day is your board meeting, and you will announce that I want to buy Axis Bank. Has anybody? So I deliberately tweeted that day to check, and people said, no, it could be Mahindra and Mahindra Finance. So that company is listed. First of all, Mahindra and Mahindra Finance is also listed. So Mahindra and Mahindra Finance will not come out and say we have done a deal, but only Mr. Kotak will come out and say, by the way, I am buying this company. Then on TV, it was discussed that he may show an interest in the following 6 companies. So by the way, hey, I want to buy one of these companies, please front run me. What nonsense is this research that we do in our... There is nothing required. There is no finance required. Then was this one. So we have this speculation, I don't know whether it's true or not, but that ICICI will buy Karnataka Bank. Okay, that he may buy, who knows. But why will ICICI Bank buy 1% stake and tell all of you that, by the way, we are interested in this company, but we are not getting an annual report. So we thought we'll buy some stock so that we can see how they deal with, shareholder queries. So, idiocy has to have some limit to which we will go in our attempts at trading and all. He may be interested, I have no idea. I don't own either of these 2 stocks, at least Kotak I own. But the point is, it makes no sense. Then was this one. This was another classic. So these guys, they did a call saying our results are very bad. And that basically they gave a guidance which was super bad. And next day, ET now says this company is being bought out. How will they justify that one day before they had done a press conference and told the existing guys that our results are very bad, and next they say, yeah, but by the way, we are about to do a deal, but we didn't talk about the deal. So this is what I was saying. It's like saying that you were expecting in a mine to get gold. And so the company comes to you and says, I'm sorry, we did not find any gold in the mine that we were searching for, and so the stock falls. And 2 days later, after having bought that stock or otherwise, they say, but by the way, we found diamonds. Because your expectation was only on gold. So we had to tell you that there is no gold. So it's the same thing. You can't do this conference if you think one day later you are being sold. So there was no question that day. That day there is no question if you connect two things. You don't want to connect, what can you do? And this was another one. So Mr. Vijay Mallya was paid whatever $75 million to move from chairmanship. So obviously SEBI will say that this is effectively like no compete kind of thing. So therefore they may say that you have to pay this 75 million proportionate to other shareholders. So they said open offer. It could be, it's not open offer to you. It will be to the guys who tendered in the open offer then, if that is the case. Because there's no change of control. So even if somebody comes and says that you have to pay more, it won't be paid to you as a shareholder. It will be paid to the shareholder who tendered at that time to Diageo, saying that they did not get a full price. Now these things, now this one may be a little bit more, but to jump in on every line of what our brother says here, wherever he is, cannot work like this. Cannot work. Anyway, so I will leave with the final words so that you can make a lot of money in your life. Investing is not complicated. You just have to buy stocks when they sell for less than they are worth. That's it. Story over, very easy. Now don't be smart and ask me how to know what they are worth, because that's very complicated.